one of the leading winning edge trading in the industry. He also runs the Winner's Edge New York Session Trading Room, heads up here a mentoring program. And we're proud to have him on here. I mean, obviously, one of the things also all us, our students, we always look for is to have a good trading room to work with and have another mentor. And it's the first time we're having him on, and it's been a privilege to have him on here. And I know he's got some great content. I've listened to some of the things he does. He talks a little bit about momentum, shows you how to find them, how to trade them, and how to double trend the trap method. And that's what's great about Chris. So Chris, I won't take too much time with him. He's going to talk about for an hour. And in the meantime, he's got his slideshow up and running. I'm going to pass him I think you have the PowerPoint here. Chris, well, I don't know if you have your PowerPoint, you're sharing your desktop. In the meantime, we pass the microphone over to him, and everyone else just stand by. And stage is all yours, Chris.
Well, thank you so much for that lovely introduction. I'm just waiting for the screen to be indeed shared. I hope that is now that everyone can see indeed the screen. Let me just check that. Now it should be available. Hopefully you can see it indeed. Great. Well, thank you so much for joining us for this lovely introduction. That is always very appreciated. Good evening. My name is Chris, indeed, the second Chris I think that you're listening to from Winner's Edge Trading, head of the trading here and also running the trading room, where we indeed look at this particular strategy. Today, we're going to be talking about momentum, so I think that's a very exciting topic, one of my favorite concepts, in fact. Really excited about that. So that is our main goal. We're going to dive into that right now, right here. Let me just quickly get the chat box so I can see if you have any questions or answers or comments, right, just in case. Good. So today's topic, as I said, what is real momentum? Point B, the truth about using momentum. And I think that will be a very interesting part. Then how do you find and trade it? And then we're going to introduce the DTT strategy and tie it all together and round it up in a strategy approach. Because, of course, one concept alone is great, but it's only a part of the puzzle. It's only part of the piece, right? And never, ever the sole solution to trading. So it's a part of the puzzle, and that's what we're going to do and explain. First of all, though, as always, as you know, I'm probably aware well of the risk disclaimer. Trading for exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information. And this webinar is for educational purposes only. So we do thank you for your attention on that. And with no longer ado, I propose that we head off and start with our topic. So what is momentum? Let's start off with asking you, have you ever heard of it, right? And if so, what do you think it is? Now, those are a lot of questions maybe, so maybe let's start off with a simple yes or no, if you've heard of it. In the meantime, I'm going to explain what we see as momentum. Okay, that is impulsive net movement, basically. And what we identify and define as impulsive net movement is shown in the 4 examples here. First of all, we want to see candles moving in one direction, or at least the most of them. That's already a significant indication that indeed we're in an impulse. We want to see bigger size candles in that direction, right? Because small little candles sometimes don't give any direction. Don't have to be all of them big size, but a couple at least. The closes are usually closer to the extreme. That means the highs are close to the close. The closes are close to the high, excuse me, and the closes are close to the lows. And we have those continuous higher high candles, right? This is different than looking at price patterns, candlestick patterns. Candlestick patterns are usually a group of 1 or 2 candles, right? You have a pin bar, for instance, engulfing twins. But this is different. Here we're talking about power, the momentum, the flow of the market, right? Looking at what the directional guidance is, where the currency is moving fast. That's different than just 1, 2, 3 candlesticks that we localize at any particular spot, without looking at the market structure, at the entire currency pair. All right, so let's dive into what is not momentum first. Here's an example. Candles are going sideways. So let's go back to that list. Are these candles in one direction? No, they're a mix, right? Are these bigger sized candles? Well, a few of them, but they're a mix, so it doesn't count. Are these closes near extreme? Some of them are, some of them not. It's a mixture again. Do we have higher highs, higher lows? We do occasionally, but there's no clear direction. It's all a sideways movement, right? One way of analyzing and realizing that is just that the price is overlapping each other. Every candle is overlapping each other, right? So there's not that momentum. So let's dive into a good example. This is momentum, all right? We have most of them are bullish candles. The bullish candles are decent sizes, some of them bigger. Most of the closes are close to the high in this case because we're moving up, etc. And we have higher highs and higher lows in most of the candles, except the doji where we just don't have a higher high. So I have one participant saying that there's no sound. I hope that everyone else can hear me. Let me just check. Okay, the rest are saying good, so maybe that that is just a problem with their audio. Good. Thank you so much for that confirmation. So these are then an example of momentum and not momentum. So let's take a look at, no, I skipped this slide. Sorry, somehow went forward 2 slides. This is, of course, the previous examples were isolated, located specifically for that price action. This is just a normal chart, your dollar 1 hour chart, and let's use these principles on this chart. Okay. Now you can see on the left where you have 3 big bars, right? Obviously these are bigger sized bars. The closes are near the low, right? There's one directional movement. All of them are bearish. And let's take a look at the non-momentum part of it. We have a mix, obviously, as you can see, after these 3 big bearish bars on the left, we have a mixture of bars, right? You can see bullish, bearish, smaller sizes. The closes are a mixture, sometimes close, sometimes in the middle, sometimes a wick. There's no directional momentum here, right? So what we mean with net impulse, as I said at the beginning, to come back to that, what we mean is that if you look at the very top where the impulse started and the very bottom, well, that's just a clear, what is it, 200-pip move. Now, the net movement of the subsequent, slow upside is minimal compared to this downside. All right, so that's what we mean. And I think that this example clarifies, I hope it does at least, if not, let me know, but shows where the momentum is in this market and where the slower movements are. So in this downtrend example, were the majority of the candles bearish with that momentum on the left? Yes. Were the bearish candles bigger in size? Absolutely. Were the lows of the candle near the closes? Surely. And do we have lower highs and lower lows? Yes. Now I was showing you, of course, a downtrend example. Logically, the opposite would be true for a bullish example. So we have all these 4 points in that move. So if you ever wondered and was thinking, is this momentum, you have a clear checklist now how you can measure that and how you can identify that. So I think that's already a great takeaway from the very start. All right, so let's move on. Let's talk about truth about momentum, because we identified what it is, right? We have a definition now, so we can recognize it. The next part is knowing some good stuff about it, which is the truth here. And the interesting part is the momentum is not that common, right? So although it seems maybe that it is frequent or it seems very attractive, which it is, we have to realize there are certain things we need to know before we take this knowledge and start trading it, as always, okay? And the truth is that it occurs, but not as common as you might think. Corrections are quite often present in the market. The corrective moves have no clear direction. Okay, basically it's price action moving, bouncing up and down and up, without any clear guidance. In these areas, we see currencies making flags, triangles, wedges, sideways corrections, consolidations, you name it. All these words mean the same. These are corrective price patterns. The net result is that the currency, in fact, hardly moves anywhere. It's oscillating back and forth. Now, how often does this occur? It really depends from case to case because the market is so diverse and so widespread. But maybe a good example could be 2 out of 3 times, for instance. Maybe some currencies even higher, right? It depends. And of course, as you can see, corrections, as I'm writing here in this PowerPoint, slow grinding moves with a mixture of the elements we already talked about. So in that regard, why would we trade with momentum? Okay, now in our opinion, an easy way to start improving trading is using the the confirmation tool of momentum. Okay, of course, it's not so that this is a overnight wonder. Nothing is in trading, and if someone says so, then I would have some doubts about it. Okay, but it is a great indication of becoming more selective and improving our odds of catching a winning trade and increasing our probabilities. And the momentum confirmation is a great one to look for. Either if you're looking for a breakout or maybe a trend continuation or reversal, it is critical to have that momentum on your side so that price is driven to our target quicker. And why is that important? Well, first of all, there's a higher chance of price hitting our target. If the price is chopping around, it's kind of becoming a bit more arbitrary. It's kind of at random. If there is a clear momentum pushing it, then obviously we have a good chance of our target being hit. So that's point one. Not only that, but we could aim for higher R2Rs, reward to risk. What are we risking in terms to get our reward, right? If we're risking 40 pips, what is our target? Is it 20? That doesn't sound too good. Is it 80? That sounds a lot better, right? And in some cases, if you have a big momentum, you could even think about bigger R2Rs because there's the power of the market is one directional and is swiftly moving that direction. And over time, you could get even bigger ones, right? So better R2Rs, which is reward to risk, and you're measuring, once again, the risk, what you're taking to the potential reward, either a soft TP or a hard TP. What else? Well, if the currency is moving fast in our direction, we are able to move the trade out of risk quicker, right? If we're up a certain amount of pips, which is far away from our entry, and we already have layers of support in between our entry and price, for instance, we can move our trade to break even, or we could even lock in some profit and still be in the trade. Of course, in those cases, we're in a very interesting position because we have the stop loss at a profitable spot, but still have space and allowing the trade to develop. So we're allowing the trade to become a winner, a bigger winner, and cutting sometimes our losses short, which is a very important part and philosophy of trading. The other method, instead of maybe going for a bigger run, would be get the 2-to-1 in the pocket, close the trade, and look for new opportunities, right? The sooner our target is hit, the sooner we can also take the new opportunity, depending, of course, on your risk management. But assuming that you take a trade and you put a 1 or 2% and you don't want to add another trade, then as soon as you hit the trade and you hit your TP, then you have a budget again to take a new trade if there is the opportunity, of course. But if the opportunity presents itself and you're already in a trade, you might not be able to take that trade. Time frames, Charlie, we'll be talking about that soon. When we trade, we're looking at 15-minute, 1 hour, We take a sneak peek at the 4-hour as well to get the structure and directional movements. But it depends, of course, on how you trade. I'm not saying that those are the best necessarily. Maybe you trade once a day at the New York close, and that's fine as well, right? But when we're in the trading room, when we're in the New York trading room, that's what we do. So 5, I definitely want to stress this part, is the psychological aspect of it, because let's face it, if we see a trade bumbling about for hours and hours, just going sideways, we're up 10 pips, we're down 5 pips, we're up 2 pips, we're down 20, it's not easy to stick to the trading plan. And of course, to a certain degree, everyone has to live through that. And I'm not saying that momentum will take away everything of that, no, but it does have the advantage that in certain cases, the trade will go very fast. Sometimes there is a bit of an approach, and then you get the momentum. But the goal is to catch the momentum, right? And then if you're in the momentum, you will have, at least with regard to whether the trade is developing, you will have less stress with that, right? Around that break-even or loss area. So our goal is to identify these impulsive opportunities and judge the likelihood of an impulsive move actually unfolding. Okay. Now I know I'm throwing out maybe a lot of info depending on how comfortable you are with these concepts, how often you've seen them. Maybe that's going a bit fast. But once again, basically, by trading, by identifying momentum, all right, so we know how to identify it. By looking for potential moves with momentum, there are a lot of benefits. But we need to know when to do it because of the fact, as I said, that momentums are great, but they occur less. Prices regularly chopping around. And that's what we want to avoid. And if you don't know about it, you're wondering what's happening, right? And you're wondering what's going on. So that's why, in our opinion, the trader's goal should be to identify impulsive opportunities, as I said, and judge the likelihood of an impulse actually unfolding in the future. A Forex trading plan, which incorporates this part, is already worth a lot of tips. And in our opinion, that is the best answer that we can give to the question how to trade it. It's a very important concept and a very rewarding one as well, we think. Okay. Now, of course, it requires some experience. You have to get used to this concept. You have to practice it like anything, which is logical, I think. Right? Just looking at it once doesn't help. You need to train it and test it. In certain situations, an impulse has a higher probability. For instance, trends. By trading trends, we increase the impulse probability, right? Because those tend to happen a bit more statistically. Okay, so let's continue with this idea of when it actually starts. Now, it is the impulse, right, I'm talking about. When does the impulse actually start? Now, that's not a very 1 + 1 is 2 kind of answer. It's not that simple. I'll definitely give you that, right? However, there are guidelines that we can use for identifying areas of corrections and areas of impulses. One of the things that I think I've noticed with traders is that it's a bit ironic in a way, is that most traders try to chase an ongoing momentum. Now, not saying that this is not possible, but in many cases, the traders enter and don't know when the momentum is over. And that could be difficult. A bit more experienced trader could still enter maybe late within the momentum, but could exit still at the right time. And that's one of the dangers, I think. Also, because once you enter at the late part of the momentum part, is basically that's when you could expect the correction, right? And if you're entering just when the correction is started, well, you can understand that this could be tough for the psychology. You're expecting momentum, all of a sudden stops, and then goes flat and goes sideways. Well, that can lead to confusion, that can lead to lack of patience, etc., fear. you name it, right? So that's what I notice often. The other could be maybe to anticipate correction too early, for instance. But many traders are lured into the market when seeing an impulse, and psychology can explain it. The fear and greed part, of course, that explains this. Okay, one of those fear and greeds is, for instance, seeing price action and not wanting to miss the boat. Not wanting to see the profits sail away. So let's talk about how we can avoid these things. Let's give an example of last week. Okay, this one was a great example because there was a good momentum. Of course, this is not always as perfect, right? But let's talk this through. This is the CAD Swiss franc. First of all, I want to note that it is a 1-hour chart. Time frame is 60 minutes. CAD Swiss franc. Okay. Now you see price action here, obviously, 1-hour bars, and on the right upper corner we see some info, which is the SMI tool we use for momentum. Okay, so we'll talk about that a bit later. All I want to, for the moment, show you is that we have, according to our analysis that we've done, basically, we have identified the trend as down, for instance, on the 4-hour chart and this 1-hour chart. Okay, so we have definitely a strong direction in this. The trend is there, and we do have an impulse here, a momentum, right, to the downside. Not as clear and clean maybe as other examples, but that motion is there, and now we're getting some correction upside with some smaller impulse at the very end. All right, now let's move on to take a look at the 15-minute chart. Okay, so this is basically zoomed in. Now, of course, this is an exaggeration on how close we are zooming in, just to give you a good view of the charts. And we can draw a rough trend line on the most recent up move, right, to create a signal for us to know that when price is breaking through it, the temporary correction could be over and we could be moving back into the bearish trend. The trend line break itself is becoming a confirmation, all right, because we're not just shorting as we see a bearish movement, but we're waiting for the confirmation. Confirmation is important to get that, because we all have biases, we all have analysis, but the confirmation is when the market speaks to us and explains that our analysis is indeed being confirmed by the market. Waiting for confirmation, therefore, it's like the market saying, yes, I'm breaking this line that you said, there is a chance, a good chance, a decent probability that we will do indeed as your analysis says. All right, for instance. In any case, it's a good trend line, and we're waiting for the break. Let's move on, and we see the first break here of the 15-minute candle. All right. Now, the trend line break, as you can see, is occurring, and we're pushing through with price, although we don't have a confirmation as yet of the SMI. Okay, but we have a clear guidance that we are getting there. Okay, not enough momentum as yet, though, to pull the trigger in a way, if you like, but there is definitely a potential trade coming. As you can see, we get the pullback indeed, out of enough momentum as yet, and we're hooking back to the broken trend line. Often, of course, something like that happens in the market. A broken resistance support often becoming the opposite in the future. We're still waiting though. All right, so when we break this smaller low, as you can see here, that's when we get the signal of the SMI momentum, right? But also visually, you can see, of course, that just pushing through the trend line. After the hook back, we continue. It's a classical break, pullback, and continue setup. All right, but this extra momentum giving us an extra confidence, of course, and an important confidence and you can see the break now accelerating in the bar, the recent bar, the most recent bar that we're seeing. So let's take a look. So we got a good momentum thrust, right? This is the 50-minute chart. Momentum could be used on all time frames. Now, obviously, the lower the time frames, the more you might want to look at different time frames as well, just to get a more feel for an entire market structure. But clearly, the 50-minute world momentum here showing, or the 50-minute bars showing momentum, and you're meeting the definition that we talked about, right? What do we see here? We see candles, one-directional candles? Surely do. We only have about a couple of smaller bullish candles. Otherwise, a major majority are bearish, first of all. These bearish candles are bigger in size than the bullish ones, certainly. The close near the low, yes. Higher, lower lows, lower highs, or lower highs, lower lows. Tongue twisted there for myself. Yes, certainly. So everything here is incorporated. And we get that good break. So this was a very nice trade. Very happy about that, of course. And it's nice. 50-minute chart, CAD Swiss franc. So that's how we grabbed basically 100 pips. This was a big move on the 50-minute chart, and a good example, right? So one question here, where is it? It is on our website. Let me state this first of all, though. We're going to discuss the double trend trap strategy because momentum is, as you can see, we think a great concept. And first of all, I hope that you were able to learn from this part of the webinar so that you have an understanding what it is, how you can use it, how you can identify it. So I think that this will help everyone's trading when you can recognize that and use this. So I think that's already very exciting. But in our case, it's still just part of a strategy. It's still part of a bigger plan, right? So that's what we're going to be discussing in the second part here. We will, at the end, have a link where you can download the strategy for free. So I think, James, if I may advise you, the best would be to start with that, look at that link, and take a look at the strategy and look at the report. It's for free. And you can read through it. If you like it, use it, take a look at it, okay? And if not, no harm, nothing lost, and by all means, we part as good friends as well. So, but I think in any case, it's well worth the time to review. So that will be at the end of our session. So the double trend trap strategy certainly uses momentum, and it uses it often. We're trying to actually capitalize on those momentums, right, in our trading room. Okay, the name is DTT, is the abbreviation. And the success rate, Charles is asking, we're gunning for 50%. In some months that falls shy, and we have it a bit less. So that varies. How successful we find our filters. It could be a bit lower. It also depends because we have two strategies. That's why it's actually called double trend trap. And we will be specifically focusing here on the breakout scenario, okay? But we also have a pullback strategy. That has a bit different setup or different, how do you say it, statistics. This one is a bit more conservative, has a bit more break-even trades. Here we can say it's looking more like a 40% win to a 20% loss and 40% a bit in the middle. The breakout, what I'm going to show you here, on average, we're trying to aim for 2 to 1 R2R. Not always do we get that, but that would be the rough average, all right? And as I said, 50% of the trades is our target for the win percentage. We use different methods, so sometimes it also depends on the method. For instance, we sometimes use trail management, trail stop loss, trade management, or sometimes we go for TPs. Sometimes the trail management actually works better Sometimes we gain by the TP because our TP actually kind of aims for the turning spot, and we are able actually to capitalize more than using the trail stops. So that also has a variation. So as you can see, depending on these local differences and also the stop loss placement sometimes varies, we have these local differences in stats. Now, don't get worried. We have all of this clear pad in the strategy, and also when we go through the trades, of course, everything is discussed and the trade management is communicated. So the rules. We're going to talk you through the steps we discuss in our trading room. And there are a few steps where we look at the market. We're looking at these steps as a way to identify if the structure of the market is in sync with our rules. So first of all, we're going to identify and try to define the trend. Okay, we have a trending strategy, and that's what we want to identify. If we don't see a strategy, a trending strategy, then it's not interesting for us. We're very strict in this. Okay, we have multiple currencies we can look at. So if one particular currency pair is not showing a trend, we skip that pair, move on to the next. There's always, or in most cases, there's hardly ever that there's not a case where one currency is not trending, right, at one point or another. A couple of them can be in consolidation, but then the other will be in a trending mode. So we're looking to define the trend. We're only trading with the trend. Let's give an example here of this CAD Swissy. As I said, we have a 4-hour and 1-hour momentum. Now, first of all, I want to show you that SMI in the right upper corner, where we see orange letters, right? What is the trend? It says bearish there. So it makes things a bit simpler. But if we like a currency, we will do the extra homework and take through the 4-hour chart and 1-hour chart. And on the 4-hour chart, we had a downtrend on the CAD Swissy, just like this 1-hour chart, in fact, because we obviously price on the left is higher than on the right. So we have that trend, but the SMI is confirming that the trend here is bearish. So if we have a bearish trend, then we're only looking to trade it to the downside. This is sticking to the plan, right, and approaching it with a good discipline, obviously, because if this is our vision, then we shouldn't be looking for longs here because we have this bearish trend, right? So that's all clear. Next thing we are looking for, that's just part one, right? So it's an easy decision tree. If there's a trend, we can move on to step 2. If there isn't a trend, we go to the next currency pair. And if there is a trend on that pair, we can move on to step 2. So we keep on going to the new pair until we find a pair that's trending. Once we have that, we can move on to step 2, which is finding the opportunity. And the opportunity basically is a pullback counter the bigger trend here. So actually, when we get a bit of a pullback, that's when we get interested. Now, one of the reasons is because the trend is great, but we just don't want to jump in anywhere at any time. Trends can stop. First of all, trends could run out of steam, and Forex market is making these ups and downs to make higher highs and higher lows in this example, or to make the lower lows and lower highs in a downtrend example. So why not have the patience and prepare a plan for that scenario? So that's the step 2. Find that we have a trend, but we need an opportunity, a pullback, for instance, so that we understand that there's also enough space for the currency to move up. Because if the currency has already moved up a lot and basically is running out of steam, as I said, then basically what this means is the momentum is running out of steam, right? And we're due for correction. As I said, hooking back to what I said earlier about the momentum losing speed and then traders jumping in, that's what we want to avoid with step 2, so that you get to the link, what I mean. And avoiding that already helps a lot because of various reasons. The trade doesn't get stuck for an overextended time. And now don't forget that our trading capital is then also our equity, our margin is stuck in that trade as well, right? And if that takes very long, then we might miss an opportunity in another currency pair. This itself is such an opportunity. This is the 50-minute chart, and when we get a counter move against the bearish trend, once again in the right corner you see bearish, okay, we will have that opportunity, right? Because this is a shorter time frame. So although price is moving up on this time frame, we're not using this as the trend definition, right? We're looking at the bigger picture here on the 1 hour, 4 hour, right? To get a feel for that direction, to identify direction. We have rules for that as well, right? What is a trend? So this upside is actually the opportunity. Now let me stop just quickly. Charlie, the SMI works on MT4, okay? That's for sure. So this is actually the opportunity we're looking for. It's a pullback against the main trend. And we can see that on the hourly chart, although this maybe looks like a good move up, on the hourly chart this would seem slower movement, right? Now we also want to check for filters. Step 3 is to double check if, for instance, if there's a big daily top or bottom, well, we might want to be careful. Also, one of the filters is indeed the presence of momentum. We want to see momentum in the market, right? Once we see momentum, we know that there's a bigger opportunity, a bigger probability of the momentum getting followed through. So that's one of the things we look at within this step. So now we have 3 steps, which I call the analysis part, basically, right? Where we are looking at the pair and saying, okay, we've done our analysis, check the pair, the currency pair has basically passed all these 3 steps. So it's on our watch list and we can monitor it and keep an eye on it for an actual entry and basically keep our vision on it. So we know that at any point, you know, the trigger might happen, we might be entering the trade and we can step up the overview and the monitoring of it. So because of course any moment, maybe any moment, 15, 30 minutes from now it could happen, we engage it a bit more frequently. So what do we see here? Well, CAD Swissy showing some bearish candles now, right? That is the momentum we're looking for. And we see confirmed yes, which is showing that we got some confirmation of the trend in the right upper corner. I hope you can see it. It says confirmed yes. Okay, so that's an extra thing we're looking for as well. So that's all available here. Once we have that, we have the momentum in the market. Of course, we know from other screenshots that there was momentum to the downside already on this example. Then we're waiting for the break, which is the trigger. Okay, so basically this is the actual trading part, right? This is the moment where we're actually going to say, okay, the trigger, price is going through the trend line, where are we going to enter? Yes, indeed, the 1 hour is the trend in that case. I got a question there from Ashok Kumar. Yes, it is. Right, so the trigger, what is the trigger? Is the trend line break. So when we push through that trend line, of course, that's the confirmation, as I said already in the previous example. That's the confirmation where we get price pushing through it. So I'm going through these examples again, so that the first time we didn't really have these steps in mind. Now we're looking through at this market, at this particular trade, with the market structure or market trading plan basically in mind, and analyzing it through this lens and through these steps. Okay. So yes, the trigger is the red line, basically. And now, once we have the trigger in place, we're going to enter, which is the strike, which is the breakout trade we've been talking about, we call strike. And the strike is part of the double trend trap, or DTT. So the strike entry is where we're expecting that acceleration. Now you can see in this particular view that the market speed is fast, not normal, and we're getting the arrow and the acceleration here. Okay, so visually as well we can see this, but the confirmation, of course, is great and is key. And as this price starts to fall, we will see acceleration. Now that is basically, as I would call it, the first 3 steps I call analysis. Step 4 and 5 are basically the trading parameters. Right here, we have to see where we enter, at what point, Where's the stop loss? Where's our TP? Do we use a trail stop loss? Or in other words, we manage the open trades, right? It's basically the trade management part. And as I said, we got different elements, different tools we use. We got a couple of main tools we use, and we stick to those. And it will depend on the structure of the market. Depends on you whether you want to stick to one method of ours, or you also vary and choose and follow us in the variations we use. As I said, sometimes we use a trail stop loss because there could be a bigger, wide open space. There could be bigger movement. There could be more possibilities, more potential. And that's with these steps, we can identify that using momentum, for instance. And then a trail stop would be an ideal option for that, because then you could capitalize on that bigger movement. And that's very exciting. So managing open trades is very important. And in this case, well, it was quite simple. We chose indeed for a trail stop loss, which was a good choice, as you can see here, because this just flew down. And then, of course, the trail stop loss is great because obviously if you maybe would have chosen a TP, well, I didn't in this case, so I don't know exactly where we would have chosen, but you obviously can see that it could be, the trade could have been exited earlier than here potentially. So this was a great example of where trail stop loss just works very well in catching a bigger move. And the momentum, the concept of momentum, basically a great element within trading strategies in general, and specifically for the ones we are using, right? Because let's face it, if you're looking at a 15-minute chart, there's a lot of choppiness, there's a lot of sideways movement during the day, as we know from our momentum versus correction kind of analysis. So to pinpoint the momentum restart is ideal, or at least the confirmation, right? One way of trading is the immediate breakout. The other way to wait for kind of the follow through. Both are relatively at the start of the momentum. That's great. However, if you enter at the very bottom here and you've already had an entire downside of momentum behind you, I think that you can see the disadvantage of entering that late. Obviously, what could we expect sooner or later? It could still go down a few pips, right? But I'm talking about specifically at the bottom, the very last candle. If we enter that very last candle, right, then what is the disadvantage? Obviously, we're exposing ourselves to huge risk. We have a tremendous impulse behind us already. So how much impulse could we and momentum could we still expect? Maybe a bit. I wouldn't say necessarily it's over. But if we put our stop loss all the way above the top, our technical stop loss, it's a huge risk. And we could expect just a small bit of continuation. That R2R isn't there. Furthermore, sooner or later, this is going to go into a correction. And we'll be stuck in a trade. And then we still have to hope that the currency then after continues in our direction, which is not always a guarantee, because the currency could actually finish this momentum and actually start to turn into the opposite direction. It can happen, right? In the positive scenario, we would have a correction and follow through to the downside. Not always, though. We could see a reversal. And we would actually be selling right at the bottom of a potential turnaround. So I think it's very clear what the disadvantages here are, and what the advantages are of waiting for the momentum to come back in the market and enter at that point in time, either upon the break or upon the follow through. Right, because we have the confirmation and we have a higher probability of the momentum flowing into the market, pushing the price into our direction. Right? Now, not always will it be, as I said already at the very beginning, not always will it be that neat, but this is to show you the example of a speedy follow through. Yes, indeed, Nathan answered that question of Ermalinda. If it's too slow, we have indeed methods of trying to cut those losses short, because that happens at certain cases. Alrighty. Yes, you need the newest update indeed. Jason already has the answer there. So the trade management, let me get the options for you out. So what we use, for instance, is Fibonacci targets, for instance, support and resistance targets, right? Scale outs, and trail stops, right, for runners, right? So that's the elements we're looking for when making this trading plan. Also, if we have enough thrust moving to break even, should be added here as well, in fact. Those are the options of trade management. So we've gone through all the steps. We've gone through the analysis steps. We've gone through the trade management steps of the actual entry. Let's sum it up. What is important here? Basically, the trigger, the break of the trend line, means the break of minor / shorter term support resistance. And when price is breaking through that, we're getting a resumption of the bigger trend. And when that happens, and especially if we trade these momentum breaks with the trend, we're stacking the odds in our favor, right? And anytime we can enter, right? No one's stopping us, but it wouldn't be necessarily wise to do that. I'm just giving you a hypothetical, theoretical example. By looking for certain environments and structures, we're stacking the odds in our favor. And also, if we look for good R2Rs and, of course, execute the trading plan and get those R2Rs, again, we're stacking the odds in our favor and building on our edge, because the edge is the method how we make profitability consistently, right? The edge is something that we have to implement time in and time again. So anyhow, getting back to this important message here, if we break through the trend line, basically, we're expecting that big momentum first. That's the key here. Let's see, I got a question from Aziz. If you see the indicator in 60-minute chart, but not in the 50-minute chart, do you take the trade? Let's see, well, we focus on the 50-minute momentum. So most of the time not. There could be some exceptions where we take swing trades and not like trades that allow traders to stay in longer, and those would then be indeed possible. Alrighty. The text size shouldn't be a problem, but because maybe here it seems small, I don't think that would be necessarily a problem, right? There's actually a screenshot there, okay, from Nathan. So if you want to click on that, that's a trade from today. It's still open, and we'll see how that goes. So our winner's edge trading room, basically we're looking for strike strategies, and we're looking for boomerang, which is the pullback. We only focus here on the strike, okay? And we have rules to avoid breakouts, false breakouts, sorry, and to look for momentum. And as I said, just to summarize, the trend, filters, opportunity. Then we look at triggers and manage the trades. So I hope this is all making sense. Great questions, by the way. And most importantly, I guess, after this explanation of our kind of structure of our trading plan, right? Here's the link for free of our double trend trap report. So if you found the momentum interesting, if you think that it's something that you would like to trade, if you think that just not only looking at price action, I'm not saying that there's nothing wrong with trading candlesticks, by the way, there's great info, right? But if you want to look beyond just maybe a couple of candles and understand the structure of the market, what's going on beyond just right here, right now, and be able to understand what the candles are saying to traders in a more general, like structural sense, bigger picture, not only looking at the current candle, what we're doing, is it bullish, bearish, and trying to trade something that's going on right now. If you're interested in understanding the market structure and understanding this momentum, then I definitely recommend taking a look at this report. It's for free anyhow, right? So I think that would be worth your time. So let me see if I can get that link, maybe for instance, in the box, for instance. Let's see. Let me grab that. In the meantime, by all means, ask me for some questions, maybe, for instance. I think Nathan probably could get that link there. Yeah, there it is. Nathan has it. So by all means, click on it if you want. And in the meantime, let's take a look at some questions if you have them. Otherwise, I'm going to show you some examples of trades we took in the trading room, okay? Oh. Now, this is an example, actually, Aziz, of a 1 hour setup. This is actually a 1 hour setup. Why is that? Because, in fact, we're using this downside. This is a 1 hour chart. It's the dollar yen. And we're looking at this downside on the 1 hour chart actually as a pullback within the 4 hour trend. So basically, the break of this orange line is indicating that the 1 hour pullback is finished. And that's where we entered. Not sure if you can see it, but there's a small little blue arrow. And there's a stipple, like a dotted line that goes to the next arrow. That's the trade drags from the MP4 platform onto the chart. That was a trade taken on the platform. That's why you see those arrows and the dotted line. I don't know if you know about that particular trick, but that's how you can see past trades. By going to trade history, click on it, you drag it to the screen, to the chart, sorry. So that was a particular breakout trade where we entered upon a 1 hour chart. Let's show an example of a lower time frame. This is a 30-minute chart. It's actually a 50-minute chart, but I used a 30-minute view so that it fits a bit nicer on the chart. That's all. This is a 15-minute trade example. And we can see the trend line being the trigger and the break of that trend line where we entered. Maybe it's difficult to see. Let me point with the pointer here where it is, right here. Okay. And we exited down below here. Now, actually, that was a bit sooner than we normally aim for, but the end of the week was in sight, and that's also the reason of following. It actually continued a bit lower, but we don't. 50-minute charts is not recommended to keep over the weekend, right? So that's what the reason in this case. Still, though, good enough for at least a 1-to-1, if not more. So in the meantime, as you take a look at this example of the 15-minute breakout, got a question from Herman. Herman, good to see you. Is the SMI more useful than the alpha oscillator? Yes, definitely. I like both. I definitely use the alpha oscillator, as you know very well. Herman knows. I know Herman, and Herman knows me, and we both like DAO. So good to see you, indeed, Herman. Great to see you. Yes, it is definitely a good addition. Wouldn't say that I would have. I mean, I will always use the AO, but it is something that is definitely recommend to add. I think it's a great momentum measurement tool. Let's see. Can you clarify the higher time frame, lower time frame relationship? Yes. Good question, Peter. Basically, we're looking for a time frame that's trending, right? If it's the 1 hour, 4 hour chart, that's fine. We wouldn't be trading necessarily a trend on the daily chart because this is more of a position trader, a weekly chart, not either, right? So that's the time frames we're kind of maneuvering in, okay? So once we have a trend on those charts, we're basically looking down one time frame, and that's where we want to see the pullback. So that's that relationship: trend, pullback, trigger. Oh, actually, Nathan already answered that. So yes, that's exactly it. Trend versus the pullback. Good. The text to me would seem fine. I don't think, to me, it's not too big. Fits nicely, I guess, in my opinion. But take a look if you want. Try it and see. You can saw the size on this chart, so you have an idea what you would be looking at. Although, of course, these are screenshots, so it's not fully, but you have an idea at least. Yes, indeed, we invented the SMI at Winner's Edge. It's a custom-made tool. Nathan says it correctly. And Dave is asking about filters. We're going to have to round it up sooner or later, I guess, because we're reaching the top of the hour. Okay, Nathan is adding that we'll look into the size of the tool itself. Okay, so that we'll keep you updated on that, if possible. And see, what was the question? Yeah, reviewing filters. I guess that will be probably the last question I guess we can go through. And Aziz is asking, do you stay out of the trade only when the indicator in the 60-minute chart disappears? Well, the indicator wouldn't disappear, so I'm probably understanding you incorrectly, but we would stay out of the trade if basically the momentum is not there, if we don't get that confirmation. Okay, so if I understood your question correctly. And regarding the review of the filters, daily tops and bottoms, very important. Looking for instance, a trade that is very close to such a resistance or support is dangerous because price might move to that support or resistance. But if it's just a few pips away, then we always have the trouble that price could use that level as a stopping spot, and then you got yourself caught in a trade very near such a key level. And that's what you want to basically avoid is major key support and resistances, such as daily tops and bottoms. And the other thing we're looking at, as I said, is this momentum. Is there momentum that we could expect that could push this trade into our favor? And that's step 3 for those who are wondering. That will be step 3 of the process, right? Filters after we look at the trend and the opportunity. Those are the first 2 steps. If those are good, green, and good to go, then we can do those filters. We don't have to look at the filters if we don't have a trend anyhow, because we can look at the next pair. So, folks, that wraps it up from our side. Thank you so much for being here and for questions and comments and your attention. And, well, I enjoyed the next webinars. Thank you so much. Cheers, everyone.